Hello, everybody, and welcome to the LikeATortoise channel. Very happy to have you here. And in today's video, I want to talk about the recent volatility we've been seeing in the stock market. And you can see that I'm wearing green as well. Yeah, just it's important to mention as well, matching colors, just like a tortoise. Okay, so what is the root cause of all this volatility, and what am I doing with my current holdings? Am I selling? Am I buying more? So what is my stance on this market volatility, and do I believe this volatility will continue into year end, or is just a short to medium term headwind? Okay, so I think it's important for us to take a step back and reassess the market as a whole. And the first thing that I want to discuss with you, and this is something that I always discuss with members in our community, there is what you guys have to understand is that the market valuation in concentration levels are at all-time highs, okay, essentially. So you can see, for example, in terms of periods of extreme concentration, and everything that I do is based on research. So I'm a very visual person, and I just want to show you this thing here. And you can see that periods of extreme concentration during the past century, you can see the periods of the highest level of concentration are right now, where we are right now, right? Because only, I think in 2024, about 40% of the S&P 500 returns were generated by only a handful of companies, right? The so-called Magnificent Seven. And you would have to go back all the way to 1932 to see these extreme levels of concentration. And even if you go back to the 2000 tech bubble, tech was also an important driver of overall market returns, and it coincided also with periods of extreme concentration. Not to say that these levels cannot continue to increase, but remember that we always want to assess our risk rewards whenever we are going into investments. And you know that I'm a fundamental driven investor, so I make bottom up decisions, right? So I look at the company first and foremost, but it's also important to keep a high level understanding of the macro and what's going on, right, as informed investors. And so this is one thing that I wanted to show you. Another thing that I wanted to show you is, for example, the US market concentration levels. And you can see exactly as I was saying, that the top 10 stocks share of S&P 500 market cap hit 30 to 38% in June 2024, doubling since 2010 to 2020, doubling from since 2010, the period of 2010 to 2014. Okay, and this was in 2024. It's even more worrisome in 2025. So we have just a handful of companies driving the vast majority of the S&P 500 returns. And what's even more concerning, as you guys can see, is that tech companies with no revenue or profits are actually flying this year. And you can see that Nasdaq with no revenues are up about 34% year to date. I mean, this is staggering. Okay, and so what does that have to do with the recent volatility that we are seeing? Is that if you have been following the channel, then you know that I've been expecting this to happen, because when you have a market that is really priced for perfection, okay, then what if something happens, and we will discuss about Buffett in Michael Burry's latest moves shortly. But if something happens that causes market participants to doubt the future prospects of a certain individual company, then that alone can trigger a sharp sell-off, right? Because remember, the markets were not pricing that in, all right? And so that will certainly bring about volatility. And right now, we are seeing some prominent investors calling out this AI bubble. They say there is a lot of fraud in the AI space. And for example, Michael Burry disclosed recently that he was actually short he was actually betting heavily against companies like Palantir and Nvidia. And then yesterday, I think we even saw Palantir CEO just criticizing Burry for doing so. But when you have a company like Palantir, I mean, these guys are trading. Let's have a look. Let's go to our stock analysis. And what you can see is that Palantir right now, I mean, this company is trading at, I think, I mean, look at this. The P is around 441. That's okay. I mean, no, it's not okay, right? It means you would have to wait almost over 400 years to get your money back from current earnings. But what's even more worrisome is if you go here to statistics, you can see that this company is trading at about 150 times sales. I mean, you can't make this stuff up. So this stock is so, I mean, has been just bubbling up. I'm not saying that Palantir is not a phenomenal company, but price is what you pay and value is what you get. And when a company trades at these nosebleed levels, then of course, down to earth investors, wise investors, start asking questions. And some of them even go to the great length to actually start shorting them. And that's precisely what Michael Burry has done. So he disclosed bets against Palantir and Nvidia. In fact, if I scroll down here on this article, I think he bet close to what was it, 1 billion. Look at that, Palantir. Michael Burry initially wrote. Okay, let's scroll down. Let's have a look. Story continues. Bearish outlook. I mean, where is this? So, formula, hedge funds not required. Very widely contrary. Jumped into the ongoing. Yeah, he even wrote this, as you can see. Sometimes we see bubbles. He wrote this on Twitter. Sometimes there is something to do about it. Sometimes the only winning move is not to play. He said that in an X post in late October. But now he just disclosed the massive short, as I mentioned, against these companies. And it's interesting, right? Because these are very profitable companies that have been hyped up a lot because they are riding the AI boom. But again, so it's one cause for concern. I always like to see what other prominent investors are doing. And Michael Burry, if you are an investor, if you have been in the space, then you know that this name is so Michael Burry is quite reputable, right? And so when he does something, investors do pay attention, and then people just start putting things together. And for example, in the latest Berkshire Hathaway filings, you can see that the cash pile just swelled to a record $382 billion. I mean, again, you cannot make this stuff up. What this tells you guys is that Warren Buffett, and when I say Warren Buffett, I mean Berkshire, right? Because he still represents Berkshire. He's finding very hard to find great investments in today's market. And I hear many people criticizing Buffett, saying that he's out of touch, that today is different, right? And the same people, many of them were saying the same thing during the 2000 tech bubble. They were saying that he was also out of touch with the internet and all of that stuff, because at the same time that people were piling into tech companies, Buffett was buying Procter and Gamble, Coca-Cola, and then what happened is once the bubble popped, you went on to outperform the market substantially over the ensuing 4 and 5 years. He made just a ton of money. And so this does not mean that we, smaller investors, cannot find great opportunity in the market right now. Remember that Buffett, it's important to set some context, and Buffett is managing a multi-billion-dollar portfolio. So for him to find companies that really can move the needle at Berkshire, this means that Buffett needs to find is limited to blue chips, right? And you know, if you follow Buffett, you know that he only invests within his circle of competence. So he only invests in a handful of companies he has a strong conviction in and understands very well. And in today's market, these companies are really expensive, guys. All right. So what Buffett is doing is typical. Buffett is just following his playbook. Because he's essentially selling into a greedy market, and you will certainly be buying into a fearful market. And look, I mean, if you are not paying attention to what some of the best investors in the world are doing, then I really don't know what you're doing. Okay, so now important. What am I doing right now, and what exactly is my stance on all of this? And by the way, if I go here and I show you the S&P, you can see, let's go to the charts, and you can see that this is nothing. I mean, there was so much buzz. I mean, the markets are definitely not crashing. I mean, look at that. So from the highs, the S&P is only down. What is this? The S&P is only down about 3%, right? And so, I mean, this is nothing. But what's important to understand here is that when you see if the sell-off is going to continue into year end, right? Then if the S&P continues to sell off, we will see companies, so many of the S&P 500 constituents going down by 20, 30, or even 40%, right? So that's a big thing. And so, for example, what's dragging down the S&P right now is the sell-off across big tech. And you can see, for example, if I go here to the watch lists, I always use eToro for educational purposes with our partners, and that's why I'm showing you the chart right here instead of interactive brokers. But what you can see, for example, is Netflix is down a bit from the highs. Look at that; it's been selling off. You can also see that Meta, yeah, is also selling off. Look at that from the highs. That's about a 20% collapse. So which means Meta is definitely in a bear market right now. Okay, so because what investors are now waking up to is the fact that, and I even make that note right here, is that, let me click here, is that the amount of capex these hyperscalers, companies like Nvidia and Palantir, are spending right now is approaching 60% of operating cash flow, guys. Okay, and the only other industry that high is big oil. These companies are spending money like there's no tomorrow, but there are no profits coming in, because remember, these are capex investments. And yes, I agree, the next AI can be life changing. In fact, it's already being life changing. But what's happening is that the multiple hasn't come down enough yet, right? So the margins are compressing because they are making substantial investments into capex, right? So they are growing data centers, all this crazy infrastructure that is going to power up AI. They are spending a ton of money without seeing profits, because they are hoping to see profits in the next few years. But what if those profits don't actually realize? Okay, that's a big problem. It should be a big concern if you are a sensible investor. And the multiple, while the earnings are compressing, their multiples are not compressing at all. So the market are still pricing them when they were growing earnings at 30, 25%. And so, yeah, one of those will have that valuation will sooner or later have to give in, or otherwise earnings will have to catch up, and we are not seeing right now, and we are not going to see that, in my opinion, because they will continue to make staggering amounts of investments, exactly to generate the future AI boom, and that will certainly cost them profitability in margin. It will certainly comprise them of margins all along. Okay, so regarding our investments, I'm not doing anything right? So I don't make any impulsive decisions, and as a fundamental driven investor, and as someone who runs a concentrated portfolio of only a few companies, as you know, I have a deep. I understand these companies very well. I understand exactly why I bought them in the first place, and what I will be doing is buying more when the opportunity comes. Some companies I'm not buying more of. So there are companies I'm not buying more of, like for example Lululemon, and I explained this in previous videos. And by the way, Michael Burry also doubled down on Lululemon, which is always very good. I shared that with our community as well. So he doubled down on the company. This means he believes also in the fact that the company is high quality and is trading at a discount to its intrinsic value. But I don't want to buy more shares in Lulu until I see positive developments in the Americas. They have they laid out an important execution plan, and I want them to see to deliver on that execution plan going into at the beginning of the next year before I make a decision, all right, as to whether or not I should buy more or actually sell shares. So I just don't know at this point. Okay. That said, the company reports earnings on December the 11th, if I'm not mistaken. That will already give us some visibility into what they are doing right now to turn the company around, and in how the consumer is reacting to the new products, to the new apparel they are releasing. But they said they were very clear in on the last conference call, and they are not expecting significant results until early next year, right? Okay, so what about other holdings, like for example PayPal? I discussed in my last video. I discussed PayPal. This thing is getting hammered, and I will buy more. Okay, mark my words, and I will let you know once that happens. But if PayPal comes back down to $60 per share, right now we are at 66. If volatility in the S&P 500 and the Nasdaq persists into the weekend, I think it's just a matter of days before we see PayPal back down to $60 per share, and I will be backing up the truck. Okay. This is another company that I have a strong conviction in, but I'm seeing management delivering on the plan, and things are working as expected. I'm very constructive on PayPal going forward, as I am with all my other holdings. But when the company gets this cheap, I mean, you really need to make a decision, and I feel comfortable buying more shares in PayPal. So, guys, I mean, this is what I wanted to say. Okay, and so there is certainly a lot of fraud in the AI space, because many of these companies don't even make any profits, and I expect them to get hit the hardest, right, if the market comes back down sharply. And in fact, now you are even seeing some analysts calling for $1 trillion potential, right, for $1 trillion company, for like a Palantir. And this is a company that right now, if I go here, you can see that the company is making, how much are they making? Look at their revenues. So they are making, their revenues are about 3 billion. Okay, they have been going up, but they are calling for a $1 trillion company. I mean, don't you think this is just a bit crazy? Yeah, but it goes to show the environment that we are current in, and all this the AI buzz that has just growing stronger and stronger by the day. And so, as sensible investors, we have to and we should always consider the downside before anything else. Okay, remember, first rule of investing is to never lose money, and the second rule is to never forget rule number 1. So, guys, if you are following the channel, please always do your own due diligence, and no matter how great the company is, only invest in companies with a big margin of safety, because the margin of safety will not only cushion, will not only protect you from further downside, but it will also explode your returns once the market reprices the company back to its intrinsic value. Okay, so be safe, don't use leverage, and if you find the video helpful, please smash the like button. It will help the channel and it will help me to put out more content like this. Yeah, guys, I mean, we are here to outperform over the long term, just the tortoise way. Okay, so be safe.